Today, we're actually having a very interesting, let's say, workshop slash Q&A. So we have an open discussion that you guys have any kind of concerns or any kind of questions to Arcanum Ventures as great advisors in the industry and also as a VC, as investors. And I guess the team wanted, both co-founders wanted to start maybe with a brief introduction, and also something interesting that they've prepared especially for you guys is sharing some of their philosophy of investment and also the fundamentals of their analysis that they perform when actually selecting the startups for their pipelines. So Sasha, Carmelo, please welcome. The floor is yours. Thank you so much for coming.
Everyone, nice to meet you. I'm Sasha, and Carmelo's here as well. We, when InMind reached out to us, they mentioned the sort of premise of the Q&A session, and what they had in mind, the vision of this meetup and this presentation. And so Carmelo and I, we've been working in the Web3 space for a couple of years now, and we've seen quite a bit. And so a lot of these topics, I'm sure we can speak about for a very, very long time. So what we had in mind is presenting a few slides, a few bullet points, just to highlight our own sort of investment philosophy, what we typically look at when we're gauging an investment, and to give you guys some actionable items that you can hopefully integrate into your own business models and try and work your way more along the lines of that fundraising stage and see, if there's any insight that we can offer you to help you out along the way. So I'll go ahead and share my screen and we can get started.
Amazing. Sounds perfect.
All right. Can you guys see my screen?
Yes, all good.
Okay, perfect. So just a brief overview on us. Carmelo and I have been in this space for a couple of years. We come from a more traditional investment background outside of Web3, but we had decided to start our own shop after working with a venture studio. And so we have a venture capital arm where we invest and back Web3 startups in the space through any phase, really. We also invest in projects or companies outside of Web3, but we focus mainly on our advisory services. We like to work very intimately with teams that we deem very strong and promising in trying to build out products that we believe align with our own investment ethos, but we believe are going to be impactful in the space going forward. And aside from that, we offer a number of different services and products to our partners and also other projects in the space. And we've been focusing as well in creating content to try and draw some insights and lessons from our own experience in this space and help educate not only founders, but investors in trying to navigate the pitfalls and the gray areas of the space. So the premise of this presentation really is just running through, a few different categories of our fundamental analysis process to give you guys a better understanding of what we personally look for when we're gauging an investment opportunity. So I believe, in the past year and a half or so, the Web3 startup arena has been evolving slowly. As we've seen some changes in the market into a down market that's been a little bit more prolonged, we're seeing a lot of investors and investment firms starting to take some lessons learned and integrating them into their investment philosophies. So, as you guys know, losses are very humbling, and we're starting to see these lessons manifest themselves in this industry now. And what we're seeing, which aligns with what Carmelo and my own investment philosophy has been since the beginning, is a movement more towards risk management. So there's been a lot of VCs in the space that have made very risky bets on startups, possibly without performing more comprehensive fundamental analysis before jumping into an investment. But because they've been burned, because they're forced to adapt, because they're forced to change their strategies to survive, we're seeing an emphasis that is shifting more towards what you'd see in a traditional tech startup, where people are diving deeper. They're taking a look at different metrics now, and they're trying to integrate that to try and limit losses and realize that it's not a numbers game. It really comes down to making sure you're backing the right teams that are promising. So they're starting to look at projects that are being more reasonable with their startup valuations. They're looking at projects that are being more thorough with creating budgets that align with what they actually plan on building and how they plan on building it, and then how they're going to pursue a business development strategy. They are looking for teams that are very resourceful, because in a startup arena, it's very, very difficult for a team that is new to this to understand the best way to approach complex problems. So they're looking for teams that are demonstrating the ability to approach challenges, adapt, and move past them effectively. And there's been a massive, massive push to focus more on finance and financial management strategy. So understanding, things in the traditional tech startup space that really weren't spoken about before in Web3, talking about revenue projections that are realistic, profit margins, and how that ties in with business development strategy and marketing. So I'm going to go ahead and give the floor over to Carmelo to talk a little bit about us some more.
Yeah, thank you. So Sasha already touched on it briefly, but basically Arcanum, we're a smaller VC. We're aware that we're not, one of the major funds like Animoca or Sequoia, but we're okay with that. We like to honor our investment theses and our philosophy, our ethos, whatever you want to call it. At the core of that, we really want to invest in making the world a better place. And I know that sounds very hippie-ish, but it's true. Like we really believe blockchain can solve a lot of problems. So we typically look for platforms, products, and even specifically teams that really want to solve problems that plague every part of society. So that's pretty much what we're looking for the most. Obviously, we're idealists, but we're also realists. So we know investments have to make money. They have to make sense financially for us. So we keep that in mind. But generally, if we have our pick of the litter, we're going to tend to go towards, companies that fill a real need, fill a gap, and actually improve the world. And today, we wanted to just highlight a few of the thousands of different criteria we've looked through. So just here's a list of 4 of the best ones we could, think of. It's a little bit of a cliche at this point, but, the team, people always say they're investing in not the product or the company, but the team. Like anybody can have a good idea, but it takes a really truly special team to execute and get it to market. And then you have business model viability. You'd be shocked at how many companies come to us to work with us to get investment. And if we ask them what their business model is, they have no answer for that. And that is hilarious, but also scary. Token design and economy. This is something we sort of specialize in. We have several clients that we work and build token economies for. And then marketing and community, which is like specifically my background before I got into Web3. I worked in traditional marketing, so I really, Sasha now too, I've taught him everything I know, and now he's a formidable marketing machine as well. But we really look analytically at marketing or lack of marketing with startups that approach us. So we have a pretty good feel for these 4 core areas. But like I mentioned, there's countless other criteria that comes into play when you're assessing the viability of a project to invest in.
Yeah. And just to add to that, Carmelo and I kind of pride ourselves on being a more boutique VC. We are entirely independently funded. And the luxury that comes with that is, we're able to scale responsibly and effectively. And we're not beholden to pressures and influence that come with accepting outside capital. So, we understand that, we want to make sure that we work with teams that align with our own sort of philosophy and mentality. We work with a small number of teams. We make sure that we don't take on more work than we can handle. And the benefit there is that we don't sacrifice our own philosophy in the work that we do. And we're able to focus on the projects, the teams that we like working with, and develop products that we feel are going to bring real value versus returns.
Yeah, so just to expound on the founding team and experience, like I said, that cliche is true for a reason. The founding team is everything. There's several companies out there doing the same thing. And if we have to look at the key distinguishing factor between them, it usually comes down to the team and the experience and the drive, the initiative they show. And we have a pretty good feel at this point, even talking a few times with founding teams on who's serious and who's not. So one thing we typically look at is the experience, not just in Web3, but more specifically the traditional realm. It doesn't have to be like, if we had to choose between a Web3 team that knows Web3 intimately, but has no strong background in or work experience in the traditional world versus, people that have never worked in Web3 and don't know much about Web3, they just know that it appeals to them and they have a strong background in traditional industry, we probably go with the latter because like we mentioned, you can bring on advisors like ourselves or any number of advisors in different specialties or special fields to kind of supplement your knowledge and your skill set. So we look for people that have actually held positions similar to the one they're holding currently. So if you're a CEO or a COO, you should have strong operational background. You should know how to manage teams. You should know how to get down to the nitty-gritty and do all those boring things that people in startups typically don't like or don't know how to do even. Another thing we see is, founders or C-suite executives on pitch decks or on LinkedIn, they'll be talking about, the serial entrepreneur is the classic example, but launching several companies, they've held a number of positions, but none of it's relevant to what they're doing now. So it's kind of a distraction at the end of the day. You kind of want to just focus on stuff that's relevant to the immediate situation. If you're a COO for a company, then you should talk about every operational position you've ever held and how that has prepared you for your current task at hand. And then another thing we look at is, personnel. Like there is such a thing as having too few people, depending on what phase of the startup journey you're on. Like if you're very early on, it makes sense. Okay, you have a handful of people. And there's also such thing as having too many people. We are very financially minded and we think about things like burn rate, for example. So if you're building a game and you have 100 people working for you, that's a lot of payroll. Your burn rate's gonna be pretty high. So we think it makes sense to keep your team lean, but have enough people to get stuff done. There's a lot of delays in crypto and Web3. Projects are notorious for delays and not rushing projects out. So we've seen. And then finally, advisors, admitting you don't know something is huge. So bringing on people that can supplement your skill set, your knowledge is everything. You don't need to have 100 advisors, but just a few to help guide you through the launch space, if you want to call it that, and beyond. There's a lot of people that have done this before, so it makes sense to yield when the time comes when you don't know what you're doing. It's okay to admit that. Or, legal advice is another thing. Like we even defer to our team of lawyers because, Sasha and myself, we're not lawyers. So we have a lot of legal questions when we're assessing viability of an investment, specifically around securitization. There's a lot of questions that are mysteries to us. So we don't want to ever assume that we know something we don't. And finally, it's not included on the slide, but probably the most important thing, especially when we meet with teams on calls, is just the general vibe or the intuition. We've seen a lot of arrogant founders before, ones that bulldoze right through you and don't give you a chance to speak. And they're not very humble. They don't accept criticism or feedback. And this tells us everything. If you're not willing to accept feedback or other perspectives, then probably not a company that we want to work with or invest in.
Yeah, for sure. That's a huge one. You just reminded me, we talk about red flags and funny instances that we see in the industry all the time. One of the funny red flags that we see is on a pitch deck or on social media channels, combined years of experience for a C-suite team, 100+ years in Web3 across, 57 individuals or something like that. A lot of the dynamic between investors and founders is psychological, but it's important to understand, how investors will perceive your business based on the information that you give them, because that is the judgment that they will make if you're being genuine or if you're embellishing metrics. So it's definitely something that we look at as well. So another a major area that we look at, obviously, business model viability. And so this comes from a lot of experience that Carmelo and I have trying to understand the promising nature of specific products within their industries. There's definitely an advantage to, let's say, first mover advantage, right? This is something that is very common in the Web3 space because a lot of what we deal with is not really invented or doesn't exist. It's important to understand when we're looking at an investment opportunity, if this product, if this service is addressing an existing gap in an industry. And so this gives us an idea if there is a product market fit, if there can be a real demand. But it's also the founder's job to create a narrative or create information that is going to help investors understand what gap is addressing and what market is it going to try and address or try and target. So if there are many inventions in Web3 every day, new ideas being popped out left and right. But the thing is, if there's no real need for this, then there's a really big concern on our end to see if is this a viable business. Now, that doesn't mean it's bad, but it does mean there's going to be a huge hurdle ahead of your company in trying to create that market for yourselves, which is going to work through marketing and educating the target audience, helping them understand why your product is important and why your service can help make an impact. But, first mover advantage, not always a guarantee. And so there's nothing wrong with creating a company or creating a product that is going to sit in an industry or in a niche that already has competitors there. But the important thing to help investors understand is what sort of competitor advantages that you have. And this can be a number of things, really, but this ties back into team. For example, if you have an advisor on board that has networking connections that can help your team along in the business development roadmap, it can help you get that first or 10th customer down the line. Or it can help you, acquire technology that you need to move your project forward. It's important to try and highlight what advantages that you guys have to be able to compete. Because, we see a lot of projects in this space that say they want to be, for example, they want to create a functionality that's going to address, let's say, some existing gap in Twitter's business model. And they're going to use Web3 technology for it. Well, it's really cool to say you're the blockchain Twitter, but what are the chances that Twitter can identify that gap? And then they can pivot resources to try and fill that gap and capture that market. That could make your entire business obsolete. So it's important to understand what advantages you have and if that fits with, what the market wants to see. As far as business model viability goes, we also look at revenue stream quality. And this is something that's sort of lacked over the past couple of years in Web3. There's a lot of individuals that are launching products and they advertise revenue figures that may not be realistic. They may not make sense given their business model. It's important to help your investors understand what revenue is, where is it coming from, how is it going to be generated? And, in this case, it really comes down to the more planning, the better, helping your investors understand that you plan for all scenarios and hopefully your business can develop some capital down the line. And that goes along the lines with business development strategy as well. When we read a pitch deck or a white paper, we understand what the product is, but you need to also help investors understand how you're going to build it and how you're going to get there and how you're going to hit those milestones. So that's where, you hear a lot of investor pitches, VC meetups. You hear about the traction, demonstrating some ability to be able to execute because, and ideas are a dime a dozen, but execution really is everything. And then there's a huge focus on our end for treasury management and forecasting. And this is something that you don't hear a lot of VCs talk about. So, it's very important, especially for a token sale, for investors to understand what are the liquidation strategies for company equity, How is that going to conflict with my own sort of gains horizon? Will it be done responsibly? Will everyone be taken care of? So, treasury management is a huge deal because it helps us understand if you guys are going to plan for the worst. And, let's say in a down market, or let's say, you hit a speed bump where development slows down or halts, how are you going to plan or create a contingency to get past that financially? Token design and economics, surprisingly enough, glanced over with a lot of Web3 startups. And we're so confused as to why, because what you're doing at the end of the day with a token sale model is you are helping investors understand what they are buying from you. And it's important, it's your actual responsibility as founders to help them understand what that actual asset is, why it's important, how it ties back into the ecosystem, and how are the utilities going to tie in with value accrual mechanisms. So if you look at, for example, a stock or equity of a company, it's very clear a lot of times in outside of Web3, you have revenue. Maybe there is some reflection of the intrinsic value of the company being reflected in shares of the equity, or maybe there's dividends being paid out. But in Web3, that seems to be completely overlooked. And so it's very important as founders that we understand what the utilities are and how the value accrual from any potential revenue will tie back to the token, which is being bought and backed by your early investors. So value transition from revenue to the token is extremely important in our book. There are a lot of GameFi projects, for example, that approach us for investment that don't really talk about revenue. And so GameFi is it's a sore spot for us because it's a low-hanging fruit. We try and understand, the gaps in this business model. We understand that if you're selling a token and the token is intrinsically inflationary because it's revenue that's going to try and create any price accrual or value accrual for that token, then it's truly not a business at the end of the day. So it's very important now that investors are transitioning more towards traditional tech startups as far as what they're pursuing, that founders try and adapt and address these concerns.
Yeah, I just wanted to add that I've seen a lot of teams talking about the token as if it's the main product. And I can see why it's easy to think that way, but that's not the case at all. The platform, the game, or whatever you happen to be building is the product. The token ideally is the unifying thread that connects everything in your ecosystem. So obviously it's very important, especially in the context of investment for a VC like ourselves. So we care about what the token does, and if it has real utility. A lot of tokens don't have utility, so it sort of looks like a lazy way to raise money. And if we have to ask ourselves, does this need a token? It's not a great start on an investment pitch. So that's one thing you should always avoid. You don't ever want to get that question. And if you do get that question, you want to have answers prepared. You want to have thought this out beforehand.
Yeah, it's a great point. And honestly, there's been a shift in the Web3 space over the past, I think, maybe 12 to 10 months. It's becoming more commonly accepted that a token sale is, a more streamlined method for a fundraise versus an equity sale. And, if, to be honest, in my personal opinion, if you are creating a product and the token doesn't absolutely essentially need to be there, there really is no huge problem with that in my mind. So, it shows me that founders are being resourceful. They're trying to, take advantage of the avenues that are there for them to try and reach their goals that they want to achieve. Now, it's important in that context that the token makes sense as far as an investor perspective. So if the token isn't essentially part of any sort of blockchain infrastructure for a product, then the real utility should be value accrual for investors and rewarding early backers or rewarding retail investors after the fact. So it's important to try and highlight that and make them understand that this is something that you can get behind, and the entire ecosystem is based around sustainability and bringing value back to those early backers.
All right, finally, my favorite category, marketing and community. Marketing is an interesting one because you've probably noticed that everybody in crypto or Web3 sort of copies each other. It's a massive echo chamber. And this is an issue for us because it points to a greater fundamental flaw or fatal flaw in a company, and the inability to think creatively or outside the box, not just with marketing, but for all areas. One of these questions we always discuss between Sasha and myself is community. And we can't speak for other VCs because honestly, there are VCs that just care about how many Twitter followers you have or how many people are joining your Telegram group. But we don't see anybody ever asking why you need to build a community. Obviously, everybody says, oh, community is an essential part of Web3. And in a lot of ways, that's true. But they don't think about the quality versus the quantity of that community. So, we really like to think deeply about what role the community plays in a project, a startup. So we tend to look at more engagement metrics instead of just glamour metrics, like how many followers you have. We literally spend time, we have our research team spend time going through Twitter, combing through Telegram, combing through Discord, actually looking at what sort of comments pop up on posts, who actually is talking about it. Do they have a core nucleus that's very engaged and hanging on every bit of content that comes out? This is very important for us because it shows that there's actual product market fit and it's been thoroughly researched. And another facet of that is nobody thinks of marketers or marketing, as a two-way street, but it really is. You can't just talk at your audience. You got to listen too. So marketers serve in those two roles, basically. They're the link between the rest of the company and the audience. So listening to the community and actually using that feedback to develop what product you're making or what product you're going to work on next is massive. Like, that's a huge function of marketing that we don't hear being talked about ever. Another massive gaping hole in Web3 marketing is the lack of creativity that we already spoke about. Just a lot of copy paste, people copying. Ironically, like if you look at now in the current market climate, most tokens are not doing well. And then you still see new companies copying old strategies. And all you have to do is look at the current performance to see that's not a winning strategy. Just copying the same strategies over and over again it's a big tip off that you can't think critically. And, we don't want to invest in somebody that can't do that. Also, segmentation is a thing that I don't see being discussed ever. Talking to the different subsets of your audience. Retail investors have different motivations than, let's say, if you're developing a game, and the gamers themselves, they're not necessarily bothered by the token price going up or down. They just want to hold tokens to interact with your ecosystem. So kind of fine-tuning the way you talk to each subset of your audience with concise call to actions, funneling them to the natural endpoint of the customer journey, whether that's downloading something, buying an NFT, playing a game, staking tokens. Every call to action should be very clear, and they should be very clearly directed at somebody, even if that means you have to create creative profiles for each subset of your audience. And literally, it sounds absurd, but this is a common practice in traditional marketing, but literally assigning fake identities to people you want to talk to. It really helps your marketing team, tailor their message to these people as if they're real people that they know. And finally, going back to what we said before about the traditional experience, traditional marketing and Web3 marketing in my mind are pretty much entirely different concepts. Obviously, they have a common thread, that's marketing, but Web3 marketing is very absurd and strange. And, everybody in Web3 knows what GM means on Twitter, but this doesn't really translate to the rest of society. And then you have traditional marketing practices that are largely ignored in crypto. The best example I like to point to is the lack of SEO. I don't know many crypto marketers that know anything about SEO, surprisingly, even after years of crypto being a thing. So one of the biggest red flags we see in marketing is having long form content blog published on Medium, which is literally doing the opposite of what you want to as a marketer. You want to funnel people towards your website and towards your offering, not away from it. And by hosting your blog on an external website, you're cannibalizing your web traffic and you're ensuring that you're never going to rank on Google. It's not very good long-term. It's not what you want to be doing.
I wanted to go back to community. I'm going to say something that might get me in trouble. So one of the big red flags for us when we are gauging an investment opportunity with a Web3 startup is if we see an emphasis being put on numbers and KOL slash influencer marketing or affiliate marketing. And so one of the reasons why you might see people focusing on metrics for community as far as size, and even in some cases engagement, which can be manufactured to some extent. There's a huge issue a couple of years ago, and even up to today, where you have a lot of projects that are trying to capitalize on hype cycles, and what their end goal is to create as much capital as possible, and they do this through word of mouth marketing, through shady marketing tactics, and what some VCs, what some investors look at as far as community goes for these numbers is because the community size roughly means that it could translate to retail investors down the line. So if you have 100,000 individuals in your community, and then let's say 20,000 of those individuals are actively engaged in messaging, et cetera, that could potentially mean 5,000 token holders once you launch. And what this means for investors is ultimately token price accrual if you have buy pressure being created after the launch. So this might be why certain investors are considering community-based size metrics, because they're trying to understand how can they create a greater gain in the early phase of this token launch. And this directly conflicts with us, because regardless of traditional tech startup or Web3 tech startup, the timeline of building a product, of launching it, of gaining traction and progressing down your business development roadmap, that's anywhere from 2 to 5 to 10 years. And so if you're looking at a potential gain within 1 year, that's based on speculation. And that gain is likely being taken prior to the team being able to complete significant milestones in their roadmap. So if we see KOLs, if we see influencers, if we see an emphasis on numbers, we understand what's happening here in the game. And then we kind of shy away from that, because at the end of the day, we want to make sure that we're making smart investments, but we also want to protect our relationship. And in our personal opinion, some of the things that we've seen the past couple of years are slowly fading away, and because they're not as effective as traditional marketing methods, or more creative and effective marketing methods. So I think that's all we got for this one. I appreciate you guys, your patience with this presentation. I wanted to sort of go into the Q&A session. We could talk about this stuff like endlessly, and we actually do on a day-to-day basis. So, but the point was that we wanted to try and present some ideas along with some lessons learned, maybe some red flags to you guys, and hopefully that can give you guys some insight in trying to tailor your own business strategies and marketing strategies in your startups.